Hello again guys, this is Siti Faraza Alonso, your classmate in insurance law. So now that you've heard from Ms. Usman about casualty insurance, let's go to suretyship. Flashback to your credit transactions. Suretyship is defined as a contractual relationship in which a surety engages to answer for the debt or default of a principal to a third party. An example of this is when you try to loan from a bank and then the bank says, yeah, we will loan you this amount on the condition that your mother co-signs it. Now that is suretyship for you. So as we can see from this illustration, there are three parties to a suretyship agreement. They are the principal, the surety, and the obligee. So minus any of that, it can no longer be referred to as a contract of suretyship because essentially a contract of suretyship is an accessory contract only to the principal contract, and we will learn about this in the next slides. A contract that is confusingly similar to suretyship is guarantee. So for the purpose of clarity, we will touch them here a bit. Take a look at this illustration. Suppose that Dusty is a surety of Steve on his loan from Paula. The latter may directly demand payment from him as he is directly liable to Paula. Whereas, if Dusty was a guarantor, Paula may only demand payment from him after she has exhausted all remedies to collect from Steve. So, from this example, we learn that one of the distinctions of a surety from a guarantor is that a surety is an insurer of the debt, while a guarantor is an insurer of the solvency of the debtor. It means that a suretyship is an undertaking that the debt shall be paid, while a guarantee is an undertaking that the debtor shall pay. Another distinction is that the benefit of excussion is conferred only on the guarantor and not on the surety. Excussion class is the proceeding whereby a creditor must proceed against a principal debtor before proceeding against a subsidiary debtor, or in this case, the guarantor. So as we can see from this, surety becomes primarily liable for the debt of the debtor while the obligation of the guarantor is only secondary. So those are the distinctions of a surety and the guarantee. However, both are alike in a sense that they both promise to answer for the debt or default of another. But since we are more interested in suretyship, we would like to know how it connects with insurance. Suretyship, like insurance, operates on the same basic principles of subrogation, as they are both risk transfer mechanisms. Second is indemnity, of course. Another is good faith, and others. However, suretyship is not an insurance contract. Accordingly, it is only deemed as an insurance contract if it is made by a surety doing or transacting an insurance business. The insurance code defines suretyship as a contract whereby one party, again the surety, agrees to guarantee the performance or non-performance of an obligation imposed upon another party, the principal, in favor of a third party or the obligee. So, suretyship is a very specialized line of insurance that is created whenever one party guarantees performance of an obligation by another party. This contract appears in the form of, for example, recognizances, stipulations, and the one that we know the most, bonds. What is the surety bond? A surety bond is a written agreement that usually provides for monetary compensation in case the principal fails to perform the acts as promised. So from this illustration, we again see the three parties to a surety bond. First is the obligee, who requires that the principal purchase a bond to perform an obligation. Second is the principal, who purchases the bond and agrees to perform the obligation. And then third, we have the surety or the insurance company that guarantees the obligation of the principal and is liable for the claims against the principal up to the bond amount. So as we could imagine from this, suretyship is the same with other kinds of insurance in ways that first, they all transfer risks. Second, the same insurance laws of the state regulate them. And that of course, they all provide in case of financial loss. But as I said earlier, suretyship is a specialized type of insurance in a sense that wherein traditional insurance, the risk is transferred to the insurance company. In suretyship, the risk remains with the principal, and the protection of the bond is for the obligee. Also, in other types of insurance, the insurance company takes into consideration that a certain amount of the premium for the policy will be paid out in losses. While in suretyship, the premiums paid are service fees charged for the use of the surety company's financial backing and guarantee. Section 178 of the Insurance Code talks about the nature of the liability of the surety. Here, it says that the liability of the surety or surety shall be first, solidary, that is joint and several with the obligor. Second, it is limited or fixed, which means that it is limited only to the amount of the bond and it cannot be extended by implication. And then third, it is contractual, as it is determined strictly by the terms of the contract of suretyship in relation to the principal contract between the obligor and the obligee. So, question. If Anna contracts Tim Insurance as a surety for her loan with Paul, could Anna escape liability by saying that her liability is against Tim Insurance since she paid the premiums and the surety bond? The answer is no. Under the law, the obligor is jointly and severally liable with the surety. In this case, Anna bound herself with Tim Insurance to pay her loan with Paul. Hence, Paul could claim against Anna or Tim Insurance or both of them as they are jointly and severally liable for the loan. Next question. If the amount of bond is 200,000 and Anna's loan amounts to 300,000, could Paul demand payment from Tim Insurance for the debt of Anna in whole? Again, the answer is no. Under the law, the liability of a surety is limited only to the amount of the bond. Therefore, Paul may not demand from Tim Insurance the payment of the 300,000 loan in whole because the amount of the bond is only 200,000. Last question. What if Tina, another creditor of Anna, is the one demanding payment from Tim Insurance? Is Tim Insurance liable? For the third time, the answer is no. Under the law, the liability of the surety is strictly determined by the terms of the contract of suretyship in relation to the principal contract. In this case, Tina is not the obligee according to the terms of the contract. Hence, it follows that she is not covered by it. Section 179 is kinda long, so we will try to break it down in the next slide. In an effort to understand more Section 179 of the Insurance Code, here are some rules to be observed in the payment of premiums in a suretyship contract. First, or the general rule is that the payment of premium is a prerequisite to the validity of the contract of suretyship. This means that as soon as the contract of suretyship is perfected, the payment for the premium is due. The second rule is the exception to this general rule, which is a situation where the obligee has accepted the bond or suretyship contract. If this is the case, then the same shall be valid and enforceable, notwithstanding the non-payment of the premium. This is because this provision is intended for the protection of the interests of the obligee. Now, if the contract of suretyship or bond is not accepted by or filed with the obligee, the surety shall collect only a reasonable amount for service fee. Reasonable here equals an amount not exceeding 50% of the premium due plus the cost of stamps and other taxes imposed for the issuance of the bond. So, you see here that even if the bond is not accepted by the obligee, the service fee of the surety is still due. However, the next rule tells of the exception to this rule, that if the non-acceptance of the bond be due to the fault or negligence of the surety, then no service fee, stamps, or taxes imposed shall be collected by the surety. Now on to the last rule with regards to continuing bonds or those for a term longer than a year or with no fixed expiration date. So, in the case of a continuing bond, the obligor shall pay the subsequent annual premium as it falls due until the contract is cancelled. The last section under the title of Suretyship is kind of self-explanatory, so I'm just gonna read it out loud. Section 180 of the Insurance Code provides that pertinent provisions of the Civil Code of the Philippines shall be applied in a suppletory character whenever necessary in interpreting the provisions of a contract of suretyship. So that's about all of my report, and I hope you have learned. Once again, this is City Faraza Alonto. Thank you for listening. Bye!